Good afternoon, everyone, and welcome to our event, When Retirement Savings Meets Economic Crisis, Lessons from COVID-19. I'm Ida Rademacher. I'm the Executive Director of the Aspen Institute Financial Security Program. And this event, as many of you know, is part of a series we've been hosting to highlight the research, the knowledge, the policies, and the leaders that can really help to triage the immediate economic shocks of COVID-19, design solutions that allow households to recover and address the structural changes and challenges that we need to stabilize financial security at the household level in the years to come. All of that's going to contribute to an overall economic recovery in this country, and it's going to take every one of us. So thanks for joining us today. The Aspen Institute Financial Security Program's work on retirement savings is made possible with the support from AARP, MetLife Foundation, JP Morgan Asset Management, and Prudential Financial. And retirement really is the foundational issue on which the entire financial security program was founded. In fact, it was the focus of the very last major in-person event we held before the world turned remote in March, the Aspen Forum, Retirement Forum, the Aspen Leadership Forum on Retirement Savings. Our event today focuses on the retirement savings system in the United States, the one we have and the one we need. And it also focuses on the ways that the pandemic has brought into sharper focus the importance of savings as one of the key buffers against economic shocks. We talked a little bit about the emergency savings. Okay, we talked a lot about the emergency savings aspects of that last week. But today we really want to dive into the formal retirement savings system in this country. And of course, not just for COVID, but also because of the recent and welcome swell of outcry against racial injustice and inequity, it's really brought several, I would say, big reveals to the forefront that I think can help us all begin to see the importance of building out a more robust and inclusive system for savings in America that helps with both short and long-term resilience and financial security, and that serves all people, especially those right now who are disproportionately left out of formal saving systems in Black and Brown communities. The Financial Security Program focuses, as many of you know who've been joining us, on the whole spectrum of financial challenges facing U.S. households. And the series has brought together thousands of folks over the last 2 months that spend time usually working on one or two specific pieces of that challenge set. So for those of you joining us today who are usually focused on the day-to-day financial challenges of households, I hope the discussion amongst our panel, which I'm going to introduce here in a minute, helps you begin to see retirement savings not as a luxury item, but as a foundational part of what we call full stack financial inclusion. Certainly, we'll be able to examine this system as an example of a solution that can, with the kind of modifications and new design features that we're going to talk about, actually serve to reduce wealth inequality and the racial wealth gap in this country instead of exacerbate it. So in addition to the discussion that we will get into right now, we'll be having Q&A at the end of the panel. So please submit your questions online, and my colleague Karen Andres will be fielding them to me over time. We'll leave time for some Q&A. And you can also join the conversation on Twitter today by following @AspenFSP and using the hashtag AspenFSPLive. So now let me stop introducing the panel and actually welcome the panel. First off, I'd like to welcome Dr. Nari Rhee, who's the director of the Retirement Security Program at UC Berkeley Center for Labor and Research and Education. Hi, Nari.
Hi.
Also, we have the Honorable Michael Frerichs, who is the State Treasurer of Illinois. Good to see you again, sir.
Good to be back, Ida.
Thanks very much. And one person that is with us, and you'll hear his voice and you see his picture online, Dr. Carl Camden, founder and president of iPSE-U.S, the Association of Independent Workers, formerly the CEO of Kelly Services, a global Fortune 500 staffing company. Are you with us, Carl?
I am happily with you and enjoying contact with people. It's excellent.
Fantastic. Well, great. Well, let's go ahead and get into it. I'm not going to give bigger introductions because I want to leave time for this conversation. We've actually never had all three of you in a conversation with each other. and your perspectives on this will, I think, help us frame out a number of dimensions of the existing problem of retirement savings in this country and some of the kinds of solutions that are out there in the mix. So Nari, why don't you start for us, if you don't mind? And what I'd love for you to do is just share a little bit. I know this you have books about this, you have entire reports, the state of savings in America prior to COVID-19, paying specific attention to some of the disparities in terms of who had access to savings in the workplace and who didn't, and specifically for communities of color.
Sure. So I think one thing it's just important to start out with is the fact that we have a fragmented retirement savings system that's largely voluntary, that sort of has taken on more and more of the weight, right? So we have Social Security as a base layer of retirement income. That's a national social insurance system that has a fairly broad coverage. That's clearly not enough for most people to live on. And so what's been happening over the last really 20, 30 years is a shift in the retirement savings, retirement income burden to private households, partly because of the decline of defined benefit pensions in the private sector, and also because of things like some, increasing the normal retirement age in Social Security, right? That is essentially a benefit cut. And also, the average person is going to live longer, right? And so you need more years of retirement. So all of those things have contributed to an increasing retirement savings burden. And by and large, American households have failed to keep up or have not been able to keep up. And then within that voluntary system, because so much of the retirement savings system is contingent on voluntary employer offering of retirement savings plans, like 401ks or 403bs in the public sector, that it's basically layered with different forms of inequality. So the first thing to start off the bat is, do you work for a large firm versus a small firm is going to be a huge driver of whether you even have access to a retirement savings plan. And then even among firms, if you're a part-time employee, right, if you're a contingent worker, you may not actually even get access to those benefits. So roughly half of U.S. workers, private sector workers, don't have access to a workplace retirement plan. And then that is further differentiated by, whether you're low wage or high wage, and also by race. So Latino workers right now, I think I'm just going to cite a state level statistic. In California, basically, it's about a third of Latino workers who even have access to a plan. And then African-American workers do a little bit better, especially because of public sector employment access. But what it all translates to is that there are race and class inequalities, right, and firm size-based inequalities in access to being able to save for retirement. And how this shakes out at the end in terms of retirement wealth inequality and financial asset inequality is that, for instance, African-American Black households who are nearing retirement have about a quarter of the retirement savings of White households on average. And it's even less if you look at Latino households. And then again, that's also compounded in overall sort of inequalities in net worth that we've seen. And the other piece that I want to draw out is that if you look at what's happened by generation in terms of overall financial asset accumulation over the last 10 to 20 years, normally within a generation you would expect inequality to broaden. So for instance, basically a large majority of the assets that are owned by baby boomers is actually owned by the top 5%. And the amount of assets owned by the bottom 50% is pretty much negligible. So you'd expect to see, and that's gotten worse over time. But what we're seeing is that we're seeing millennial households actually reach the comparable levels of financial asset inequality, 20 years earlier in their household economic life cycle. And so what that portends is that that given the way things are going, we're really headed towards really intensified wealth inequality, retirement inequality. So I'll stop there. That's pretty much the picture really before COVID-19.
Thanks, and just to kind of connect this back to a couple of our other series, there are reasons for that generational growth and inequality. There's certainly student debt has got to be a piece of that, and the changing kind of connection to labor markets. Are those kind of some of the key drivers in that dimension?
Yes. So because employment has become more precarious, and that's become the fact whether you're a W-2 employee or whether you're an independent contractor, just work has become more precarious. There are less stable attachments between employers and employees, and so that's had a negative impact on people's access to employer-sponsored benefits. And also, it's contributed to things like income volatility that make it hard for households to save, right? So it's interesting because we have a DIY retirement savings system in a context where households are also, for instance, facing 20 years at the bottom of stagnant real earnings. So it's just become harder and harder to find the means to save, and at the same time, I think employer contributions to retirement have also been reduced over time. So I think just whether you're
a perfect storm.
It's just the precarity translates to reduced opportunities to accumulate retirement savings.
Yeah. Well, I'm going to pivot this to you, Treasurer Frerichs, in a second, but one final question that I think will help us make that bridge is everything you've been talking about is just what's been going on empirically measurably for a number of years. And now we're in the middle of this COVID crisis. And there's been a couple of things even in the CARES Act that allowed people with retirement savings to access them, even if they have them. But my sense is that part of what that creates in terms of the big reveal is even greater disparities between who has financial buffers for resilience in this now and who doesn't. So could you say, is there anything you want to say about kind of the during, I wouldn't say post-COVID, I'd say in the midst of COVID, what is looking different about the retirement savings system? And it either could be on the employer side or on the access side.
I'm sorry, is this for me or?
Yeah, just for you. It's like a final piece because I know.
I think we saw what happened in 2008, and we can expect. So what's happened to the financial market is a little bit different. Because right now we're dealing with a sort of collapse in employment, right, and the GDP. But especially in terms of the impact on, well, first of all, workers of color were really the first laid off, right, as in that first wave of employment loss because of the kinds of sectors like hospitality and restaurants that were being shut down. And I think as we go forward, there's a big question mark about what happens to older workers because there's been this expectation that people work longer in order to accumulate, right, the higher Social Security benefits and have extra years to save and fewer years of retirement to fund. And what happened after the 2008 collapse was that older workers who were already on the margins of the labor market really lost their toehold, right? Yeah. In the labor market and had a really hard time coming back. And the fallout for people who, had any retirement savings was at first they dipped into the 401ks and then they claimed Social Security early, right, with a huge lifetime loss in monthly benefits. So I think, I worry about that in terms of what's going to happen over the next year or two if that's going to repeat itself.
Yeah, we'll get into that. There's going to be we're going to skip a week after this week, and then the next one will be on the future of work. But there's going to be some strong linkages there, and I know that Carl's going to want to get in on that. But let me pivot to you, Treasurer Frerichs. And one of the things I think that Nari didn't say, but that is part of the story of the 55 million or the half of workers who don't have access to a workplace plan, is that a lot of that's concentrated in smaller businesses, and there was interest at the federal level in expanding and addressing some of these challenges to the private sector retirement savings system. But over the last few years, it's really been the states that have taken leadership in that space. So to kind of the pre-COVID problem of access, you all have really stepped in and played a role there. Would you say a little bit more about what you're doing? What is this Illinois Secured Choice work, and how does that fit into the role that you do in your day job?
Great, thanks, Ida. I know that you have a diverse audience here, have different background, but let me try and hit some of the high points. Illinois Secure Choice is a state-administered retirement program that helps individual workers save their own money for their own accounts. It's specifically made for workers who lack access to an employer-sponsored plan. So in Illinois, if you have an employer-sponsored plan at your workplace, Secure Choice is not for you. You can keep using that. It's important to know workers are automatically enrolled. In Illinois, we have a default contribution rate of 5% into an appropriate age-based target date fund. Employees can increase or decrease that amount or opt out, but they are automatically enrolled. These are put into Roth IRA accounts owned by the workers. And that's important because they're then portable from job to job. Employers play a role, but we've kept it a minimal role. They register, they upload their employee lists and facilitate payroll contributions. But unlike with an employer-sponsored plan, they don't pay any fees, they cannot contribute, and they aren't responsible for administering or reporting. That means they're not fiduciaries. We launched our program in the fall of 2018. It applies to every employer with 25 or more employees that don't have a qualified plan and that have been doing business in the state for at least 2 years. Where we are today, we have over 65,000 funded accounts with approximately $25 million in assets under management. That translates to about 5,500 employers that are already registered for the program. And we're looking to onboard thousands more over the coming months. The program makes it easy for workers to save, and that's, I think, why we're all on this call here today. It's simple for employers to facilitate. It utilizes key design features like auto enrollment with default options, and once again, it is portable.
When you, there's a fascinating deeper story about the process of even getting to the point where you could implement this program in Illinois, and you're one of many states that have taken leadership to do this work. And it's really, look, these programs are so important, but they're still nascent. And then here comes a global pandemic. So, you know, there's questions about, are people going to be able to save? Are they going to be needing these dollars? Have you seen anything during the pandemic, any early evidence of what behaviors are with relation to these accounts and the plan overall?
Well, we're very much aware that we're in unusual times. And so we've been tracking employer and employee behavior closely since the pandemic began to impact Illinois about mid-March. So the good news is we've not seen a huge increase in withdrawals. We did see a slight uptick in the last 2 weeks of March, but since then we've flattened out and have even fewer withdrawals than we did during portions of January and February pre-COVID-19. So we think that's good news. There has been a reduction in total contributions in April and May. This is likely a sign of employers who had to temporarily close, as well as those who may remain open but either cut back on hours or cut back on the total number of employees working. Everyone knows that restaurants and bars were closed down. A lot of those people in the hospitality industry were working without any retirement savings before, and so they're part of Illinois Secure Choice. But good news, we're starting to see this number increase in June as more employers begin to reopen here in Illinois.
Great.
We've seen slower growth, but still increases in registered employers and number of funded accounts. That's good news, not going backwards, not growing as quickly as we'd like. But this year was initially supposed to be about onboarding thousands of Illinois employers who missed their registration deadline for the program. COVID has certainly stalled these efforts. However, we continue to see new employers enrolling and starting payroll contributions. Growth has been slower than previous months, but it's still positive. So even though we didn't see major changes in saver behavior, the structure of Secure Choice is important to think about during this pandemic and economic crisis. With the Roth IRA option we default into, savers have access to their contributions penalty-free. All the dollars they put in, they can withdraw if they need them. Very early on, we shifted our messaging to make sure savers knew they had access to their dollars when and if they needed them. And I firmly believe workers who had a Secure Choice account were better off for it. While it's a retirement account, those dollars were readily available as emergency fund if needed. And we know that some did, but thankful a lot didn't take advantage.
That's great news. It dovetails with so much of the research that's happening now that shows, I mean, a couple of things. One, a facilitated savings mechanism, whether it's for retirement or emergency, right? And especially with the design features you put in, really drive those defaults. And we also see on the flip side that just the access to savings, having some kind of a buffer creates such a measurable difference in people's ability to withstand some of the economic shocks. Of course, it's not in lieu of, it's a complement to other kinds of safety nets. And I know that those two have been something that's been deeply creating both pressure and need for leadership at the state level. So, you know, I know that even just to that end, knowing how many things are on your plate right now, thank you for making time for this webinar today.
Sure.
I'm going to pull you back in, but I want to grab Carl and pull you into the conversation as well, because for those there, I'm kind of building this concentric circle of people are covered in the workplace under certain employers, and a lot of the larger employers, as we know, have 401k plans and coverage. That next circle of smaller employers is a harder place to reach, and states have come in those places. That's also where a great deal of workers of color are in the workplace. And then the third place where we really still don't have a full solution is around contingent workers and gig workers and independent workers in the economy. Because in the U.S. we do have, Carl, as you like to say often, a very interesting approach to providing benefits like health and retirement, and that's connected to the employer. So how about if you introduce yourself and iPSE and a little bit of the reason you exist in the world?
Great, thank you. When I was the CEO of Kelly Services, we started tracking what was taking place with job life cycles around the world, and particularly in heavily industrialized countries and like the United States and parts of Europe, job life cycles were declining. The amount of time you could expect a given job to exist in a given locale with a given employer was steadily decreasing. And around the world, as Kelly was providing temporary employees, we saw an increasing use of independent workers as the source for how companies were getting work done without a long-term commitment to workers, because again, rapid change in product design, location, technology, and so on. And in fact, in the United States, you had pre-COVID, you already had a third of the workforce making the majority of their income as non-employees. McKinsey and others all seeing that track nicely towards the 50% plus mark. And then with COVID coming, we actually expect that increase to pick up. In most other countries, it doesn't cause the same crisis in terms of benefit access and retirement planning like it does here in the United States, because in most countries, it's considered a right of citizenship to have access to benefits and to have access to post-work income streams and so on. But here in the United States, we picked a model that placed that burden heavily on an employer in a time when employment is on its way very soon to be in a minority work model in the country, and we've made almost no progress towards establishing what the alternative mechanisms are going to be. So post leaving Kelly, we formed the Association of Independent Workers. We now have 15,000 and growing independent workers in. We have been building portable benefit packages, so regardless of how and where they choose to work, they have access. But always when we do surveys and look at other people's surveys of independent workers, and their top 3 concerns is specific difficulty, large difficulty with access to appropriate retirement planning mechanisms, the education that corporations and businesses used to provide, not easily available, the structure for retirements, much, for retirement savings, much more limited, and companies much less willing to participate in helping them through the education process and the establishment of those programs. So retirement's one of the reasons I was excited about being on this panel is that while we keep talking about it in terms of employee language, when we end up rapidly in a world in which, if not the majority, nearly as large as the employment world, a group of people who feel disenfranchised by the retirement savings model in this country, that's a problem. And then to the, to one of the additional issues, that burden tends to fall, and that difficulty and lapse of access is much stronger, much greater among people who are economically deprived, among our minorities inside the country have much less access. And so while we all trot out the examples of the successful and well-financed and well-supported by education of the engineers, the IT coders, and the research scientists, we're very, very concerned about what's happening to those who are in the rideshare programs, those who are providing warehouse work, those who are working in situations in which we know and we're seeing demonstrated by COVID response are the most fragile, the least enduring, the least likely to persevere in times of crisis. And so coming out of COVID, we're already seeing a significant increase in the rise of independent workers, but we are also seeing a significant decline to access to traditional employment for those with less education or those who have been at the lower end of the, of the compensation paradigms. So working hard in terms of how do we go about providing that support, the education, the structure, and so on inside a country which doesn't make it a function of citizenship.
Thanks for that. I'm seeing Nari nodding her head along, and the same with Treasurer Frerichs. Rather than pitch another question right now, I actually wonder if you all want to weigh in with each other, comment a little bit on your own pieces of what you've talked about in terms of this stack of solutions right now that don't quite hang together as a full savings system in the U.S. as one facet of benefits that Carl teed up.
Mm-hmm. So there are a lot of things, but I'm gonna just pick out a couple of things. I think one is that given the continuing role of employers, not just in retirement savings, but like all the facets of sort of economic security, social insurance, so unemployment insurance, paid family leave, right? All of these benefits that are offered through the employment relationship that independent workers have a really hard time getting access to. So there's, you have to, I think you have to approach it at two levels. One is really employment policy and labor policy. So as you know, in California and other states, there's been a move to classify platform workers as employees and to give them access to things like unemployment insurance and other workplace benefits. So I think that's something that's, that was an ongoing kind of political debate, policy initiative, right, that this is happening in the context of, and I think COVID-19 has really intensified that, right, in a lot of ways. And then secondly, I think one of the challenges addressing the needs of independent workers with portable benefits is scale and efficiency. So I happen to know just iPSE, and also I work with a lot of labor organizations with domestic workers. Everybody's trying to figure out, right, how do we get nannies retirement benefits? How do we get them paid sick leave? And one of the challenges in all of this is basically how to provide that in a way that's cost efficient, right? Mm-hmm. And it's truly portable, because you have to have fairly large scale to be portable. And I think that was one of the reasons why I was such a big fan of the secure choice type, auto IRA type initiatives at the state level, because it has a potential to actually go there. So I do think that the crisis right now is making us, as a society, take a really hard look at all the different ways that we're vulnerable, right, in the labor market and financially. And really, what is the role of the public sector, right? And I think we need to be asking really hard questions about what are our expectations about individuals, right? What are individual responsibilities in the system, and what is the collective and public responsibility in the system?
I love it.
Yeah.
Thank you. I think I'm going to add to our lexicon. We've all become familiar with a certain kind of PPP, right, with the payroll protection plan. But I'm going to throw out two other PPP acronyms that I think relate to this conversation and this moment of reckoning of choice points in our society. You know, one is public-private partnerships, or in some cases private-private partnerships, and the other is pooled purchasing power. And I think Treasurer Frerichs, to you, I'm going to punt both of those to you because I think you've got a story in both places about how you could show up to help solve this problem.
Yeah, they both fit with us because Illinois Secure Choice, when we tried to pass this, we heard a lot of people saying this shouldn't be a government takeover. Employers should be the ones handling retirement security. And I would say I agree. Unfortunately, half of them do not. And with the changing nature of work, with more contract workers or gig workers, it's just not happening. So for those who were worried about government taking over, in Illinois, the rules would be, well, you messed up your own pension savings. Why should we trust you with ours? I would tell people, don't trust us with them. We have a private sector solution. But government can facilitate those economies of scale of public pooling, which allow us to get a better rate, lower fees than these individuals might get on their own for comparable services. And so I think the state of Illinois here benefits from both of those alternate PPPs you mentioned here. We work with the private sector. It's a good example of how government can facilitate the private sector doing something and lower fees by bringing together the purchasing power of 1 million new people here in the state who should have access to it.
Thanks. And Carl, I want to bring you back into as well, because I think one of the other choice points that Nari brings up is, I think this is it's one that we all really need to understand the implications of, but the idea of, the employer role. And I think, we have, for the retirement system under ERISA, we have employer as fiduciary. For many other ways of imagining employer role, it's increasingly, people are thinking about it as distribution plan channel for workplace. And so I just wonder what your own take is on this. And when you think about solving the problem for workers, how do you help us think about the role of the employer, or really what you teed up as something that is quite unique to, I think, the U.S. and the UK systems?
Yeah, an employer is a problematic word, because when you look at the independent workforce, and while we can talk about the California case and some of the the AB5 battle that took place there and elsewhere, but in general, for the majority of the independent workforce, they're in employment situations of one, and they don't have an employer. They're their own employer, and what they have often is a platform that helps them find the next opportunity. But for, again, the tech, the scientists, the engineers, and so on in particular, they're not staying with any one provider long enough to trigger a co-employment situation. And then what's interesting, given my background, in the academic world as a psycholinguist and dealing with language, they never, ever, ever want to be referred to as an employee. So for this group of the better educated or more experienced and less, and in a higher ability to charge for the rates, they don't have employers. The language, the conversation, the solutions that's based around an employer doesn't make sense. And in fact, when you hit their chat rooms, when you talk to them, when you bring them together collectively, they do want portability of benefits, and IPSE's sister organization, iWorker Innovations, does that. So you can get to portable benefits, not through an employer. But as we started, the individuals who are left out and find themselves in the more tenuous situations are those, again, in minorities, lower education, access, and lower pay scales, and they find themselves not necessarily looking for an employer, but definitely looking for that, that access to employment benefits. And in those cases, we talk about the platforms. What's the responsibility of the platforms to provide education, to help provide training, and to make them aware of the alternatives? I don't know if I answered every bit of the question you were looking for there.
No,
but...
that's okay. I mean, I'll circle back with the PPP piece. And, well,
Oh,
yeah,
I'm
go ahead,
sorry.
Treasurer.
Done.
Jump in. Treasurer Frerichs is asking you a question.
Yeah, I think, well, I'll answer your question, but I just want to add, as it relates to our program, we're hoping the portability of secure choice will be a benefit if workers end up moving from one employer to another as a result of changes to the labor market. In March of this year, we opened up the program to gig workers and self-employed just before everything started collapsing. We hope this can be a tool for those who want it.
Mm-hmm. And you actually bring, well, when we were talking yesterday, or when I was listening in on the conversation you were having, yeah, profit. I do want to kind of circle up around this question of portability. For Carl and his population, it's an essential, right? This is it's a set of benefits that you said are tied to citizenship, Carl, in your mindset, and that also any job is going to be stringing together multiple kinds of income streams. So portability and a singular point is going to be important. When you talked yesterday, Treasurer Frerichs, we were talking about portability and the incremental improvement that happens because this is a state program, but the impediments because we actually don't have a federal solution to some of the solutions that you're trying to lead on right now. So I wonder if you might, I don't know, wax poetic about, what you really hope happens in the next decade, and maybe even because of the implications of COVID, but like, do we accelerate the interest in the problems you're trying to solve back to the federal level at some point? And is that helpful to you, or is that something you'd rather not see?
Well, I think there are things.
The portability.
Yeah, I think there are things we can control and there are things that we hope happen. So in terms of things that we control, I think there's a lot that can be done to make plans more portable. We've done what we can with secure choice, but for the private sector space, portability would hopefully ensure more continuous coverage and help to avoid situations where folks just take their money out or lose track of it. At the state level, we've tried to create something to be very portable, but we realize that all Americans aren't tied to their state. People move out of their state. And I'd like to see something so there's greater portability around the country as people move, and that's going to require a federal solution. If you ask me to wax poetic or to imagine or envision, be careful what I say here, but I told people when we were passing this, and I've said recently that quite frankly, I hope that Illinois Secure Choice goes away in the next decade. And not because I don't think it's a worthwhile program, but my hope that is it's replaced by an equally good or better federal program. I mean, that's really, I think, where this should be happening. But supporters of retirement security have been trying for a federal solution for, well, I don't know how far you want to go back, 10, 20 years, and probably longer, but there have been real efforts for the last decade or more that haven't really gone anywhere. And so, even though I believe that's ideal, I believe that states can be laboratories of democracy, and that states who can should step up, set up a system to help their citizens, but also to provide an example for other states and for the federal government. So really what I hope is that we do such a good job, and you see both employers and employees so happy with what Illinois Secure Choice is doing, that other states are going to follow our lead. And when enough states follow our lead, I think eventually the federal government would step in. And so I'm happy to cede this program to them as long as they don't water it down and take away a lot of the important factors that we have in Illinois Secure Choice.
Nari, do you have an opinion on this as yourself? I know you've been working very hard with California on the Cal Savers program.
Yeah, and I'm just thinking about like when this started. I first started working on retirement issues 10 years ago, and that was when Senator De Leon in California was essentially saying the federal government is doing nothing. We really need to move forward in California. And it took quite some time to get everything off the ground. I think that I want to pivot back to the employer role a little bit in conjunction with this, because I do think this matters at the state level and hopefully at the national level, which is the role of government in setting standards, right? And that mandates actually play a role here. There's an employer mandate, right? Do you want to offer a retirement plan of your own, like a 401k or a pension, or participate in the state-sponsored, privately managed retirement savings plan? And I will tell you, there was some debate about this in the labor community about, is this something that we want? And it's like the minimum wage. Can the public sector play a role in setting standards? Because I do think that there's an employer role for recruitment and retention, right? There's a prompt here, right, by Illinois Secure Choice, by the California Cal Savers program, which is the prompt to the employers is you have to do something. Right, and so you can sort of take the kind of the sort of the easier route, which is a state-sponsored program, because you don't have to think about, right, you just enroll your workers, you don't have to think about the rest of it. There's no fiduciary responsibility. Or do you want to contribute to your employee accounts? Do you want to offer a more robust employee retirement benefit? And I think that that's actually really constructive, right? And so it's not necessarily about the state taking over the retirement system, but that you've created a regulatory environment in which employers have an incentive to do something and hopefully do something better than the minimum.
Right. So you've created a new floor. Sorry, go ahead.
Oh, I was going to say that, yeah, I shouldn't have to have this job. We created a great incentive for employers, for plan providers. With this mandate, they have to do something. And so when people said the private sector could do a much better job than you can, Treasurer, than the state of Illinois can with all your problems, they said, great, then go out and market to every employer out there. It took us a few years to set this program up. And in that few years, employers and plan providers knew this was coming. They could have easily gone to all of these employers and said, do you trust the state of Illinois to manage your employees' retirement? And I'm going to guess the answer of the majority of people would have been no. Well, then you have a choice. You can either sign up with that state program you don't trust, or you can sign up with me. What a great marketing tool. And do you know how many plan sponsors went out there and signed up new employers? I don't know of any. I'm sure a couple did. But that just proves my point. The state really did need to step in, because there was a certain class of employers and a certain wage scale of employees that the private sector just doesn't want to handle. And that's okay. I don't view myself in competition. We're just picking up those who the private sector has left behind.
Yeah, I think this is a prime question for what kind of inflection point are we at as a country? Where are there market failures? Where is there holes in the safety net? And is there a growing sense of the proactive role the government needs to help take to come in and solve some of those problems? And I say that knowing that you're actually also going to be up against extreme fiscal constraints in coming years, right? With both tax revenue from both households and in businesses, being hit by this work. But I do wonder if it's a moment for changing perspectives of what the role of government is as a facilitator or standard setter or last resort for the safety net to be made whole. And I don't know if you've got an emerging sense of that yourself across the range of programs that you look at, Treasurer?
I would say the state plans certainly play a role. We removed the fiduciary from the employer. That's important to a lot of them. But I also need to make clear we don't have the same benefits as qualified plans. And so that means is the state can't just take over everything. I know there's some people express concerns about that. We have lower contribution limits. The state cannot match, or the employers cannot match an employee's contributions through our program. That being said, a secure choice account is tied to the employee and not the employer. We think that that's valuable. Utilizing this model, but if the federal government would allow us to allow for higher savings and for voluntary employer matches, that could be an interesting thing to look at going forward. Right now, I think we take care of those who fall through the cracks. Those who have higher salaries are probably well served by the current private sector. But I think it might be a time to revisit what the federal government allows state plans to do.
Mm-hmm. Going to remind all of our listeners today that we're going to take questions. So I'm looking for some to come through from Karen. She's going to slack them to me on the side over here. But Carl, I want to bring you back into this conversation because, you know, this often happens in a retirement conversation when we kind of focus on, we now have two kinds of systems that can cover people, and there's still a whole set of folks who there isn't a different kind of solution around. Now, Secured Choice last year with Open MEPS gave an opportunity, I'm guessing, for some of the kinds of ways that you are thinking about pooling and offering and serving growing number of workers who don't have access to either they're not in Illinois or they're someplace else, they don't have access to those plans. And I'd love it if you actually talk a little bit about one of the examples of when you think about more of the low income contingent and independent work population, what are some of the options and how do you see this going forward to really scale up access to retirement and to other critical financial security benefits?
I'll do what I can with it and try to respect the time limits here. You know, again, all the solutions we're generally talking about here are by employers for employees, and it's my job to fret about a large population that aren't working for an employer. They're working for themselves in universes of one. I will say that some of the insurance companies who are participating in the seminar today are working with us, are investors in, and are building portable products that can be group rated, even with even with people not belonging to a single employer or a single occupation. So the insurance industry is cooperating as we move forward, and some states are beginning to try to help too, because it's not just enough to be able to offer benefits to to the non-employee workforce, which again, I just keep reminding us is going to be at least as big within a very small number of years as the employee workforce. But you also have to do it in a way that's affordable. And so we've been working with states, we've been working with regulatory bodies, we've been working with insurers and others to get to group rated products for people that are intrinsically difficult to group rate, and lots of good progress being made. The question is, who is responsible for education in a non-employer model? And again, I would urge that we look at platform companies which have a large portion of the independent workers finding their next assignments, their next work possibility through the platform, that we help them engage in a way that makes it possible for them to do underlying support for retirement savings, and even more importantly, for the education behind that. And again, it's important that we talk about deployers of this talent as much as it is as we talk about employers in the old model of working.
Can you, I'd be remiss with my colleague Karen Andres if I didn't ask you to give a specific use case of your partnerships, if you're willing to share. I think there's some stuff that you're doing with transport.
Yep. So on one side, we have formed a coalition with people who are participating as independent workers, are finding it difficult to gain access to the American benefit system, Coalition for Workforce Innovation. One of the co-leaders of that with the CEO of Lyft, working our way through how do we go about providing this type of portable benefit structure. And then working with insurance companies is how do you approach group rated products for people who are intrinsically not members of groups. And tremendous concern and active into the people who are most in danger of being left behind, again, are lower income, less educated, people of color, and we're not focusing on their access to these types of retirement planning and benefits in a non-employment world. and I ranted on you, so I don't know if I answered
That's
your
okay.
core
No,
question.
it's good. And I actually want to ask a question. One of our partners is Nest Insights in the UK, and they have also been thinking hard about independent workers as they expand the ways that they serve. They are a unique institutional provider. In the US, we provided a product for a little while for people who didn't have, at the government level, for people who didn't have an account called MyRA, and that went away a few years ago. But in the UK, they really thought about not that we need a product, but we need certain institutions to serve the role. If you're going to reduce the role of an employer to facilitating access, and you're going to expand that to other people. So Nest is an institution that was there to catch the fallout, to catch the folks who were not particularly being competed for by the rest of the market in their pensions plans. But interestingly, when they switched to focusing on the small business side of things, they actually have a hypothesis that in order to get people into pensions and long-term savings, they may actually need to couple it with a short-term savings product that's offered first, because the issues that come up for people are liquidity issues, are these financial shocks they want to self-insure for. So they're actually trying to imagine how they pair them, and there's certainly experiments here in the US too with pairing emergency, short-term and long-term savings. So I'm just wondering if you're seeing that with any of the kinds of adjacent products that you see the need for in the population you're working with. I'll stop there. Just wonder about that, and then if other people have a sense of the need for both short and long-term savings and how this might fit together in the long run, would love to hear it.
Sure. iPSE-U.K, there is an iPSE-U.K, as a sister organization of ours, founded a few years before we started, and have been doing that type of advocacy and helping do a lot of these fixes, because the UK is also a country with a larger proportion of independent workers, and very familiar. And it's a challenge because one of the biggest threats, again, on the survey data shows, to independent workers doing, staying true to the savings, is that their savings that they're currently building are almost always immediately available to them. And one of the phrases that keeps popping up in the qualitative research is, well, I can pull it out of my savings account, it's okay, because I'm going to be able to replace it with my next assignment or my next gig. So I think these programs, as you were describing, are very important. They've been critical in the UK and will be critical here.
Any comments on that from you, Nari, or Treasurer Frerichs?
Yeah, so this is an issue that was raised early in the process in the development of CalSavers, which is because the target is the lowest wage workers in California, the average annual earnings would be around $30,000 a year, right? So low-income workers, and so there was and still remains some concern and needing to actually collect good data on this question, which is when you take automated retirement savings of 5% deduction out of workers' paychecks, so we're already at pretty low income levels, what is the impact on debt, right? Mm-hmm. And the fact is that's an empirical question that we need to answer, right, as the program goes on, and Oregon and Illinois, right, there needs to be some data collection to figure out what's actually going on there. And so I think there was early on a recognition that this program could serve as, you could actually add on a sidecar for shorter term savings. I will say that that in California and Oregon, and I don't know about Illinois, but the first $1,000 goes into essentially something like a money market fund, right? Something very low risk, so that you're not exposing workers to stock market volatility just as they start launching. And it's a Roth IRA, so the money is, theoretically more accessible, but really you don't want to encourage people to dip into the retirement savings. That's for the long haul. So I do think that it's really been a matter of setting up the state programs and getting them off the ground so that they can just fulfill their core mission. And then once that happens, I do think that there are some really strong possibilities, because it would be pretty, I don't want to say easy, but it makes sense to tack on a short-term retirement savings product alongside that.
Great.
Yeah, my comments are not that much different. By design, Secure Choice tries to provide access to savings when needed. The Roth IRA vehicle was chosen intentionally because we wanted savers to know they could access their dollars penalty-free if they needed to. We don't want them to, but we let them know that. It gives them a sense of confidence to go ahead. You don't have to opt out of this program if you're worried about needing the money. But that's not the same as a separate emergency account, but it's with that liquidity option in mind that we set it up. So we're interested in looking at how an emergency account could be built onto a program like ours, but that's something we want to dive into once we have the program fully up and running.
So I'm looking at our time, and the questions that are coming in are big picture questions, folks. I'm just going to say we have a lot of folks who are you're being inspired to think about the system we should be creating for the future. I was just on a call before this today, and I talked about how, well, I think it's true in a lot of the survey data we're seeing, but it's also true in terms of how we're all thinking and reflecting on the systems we had pre-COVID, that it's looking at where the holes were in our safety net and our retirement system, looking at the ways that the current moment has brought things into such stark relief about what wasn't functioning to begin with. You don't want to just go back to where we were. You know, how do we build back better? And so I guess I'd like to ask, in the context of retirement savings, when you think 10 years out, you know, what are a couple of features of the kind of retirement savings system we need in this country that we should be thinking about to build back better? If you could put things at the top of your list for others listening, or for policymakers, or for the private sector, what would that be? And I just want each of you to kind of conclude with just some request.
Okay. Well, I would be remiss, first of all, especially with the populations that we've been talking about, with you know, Black workers and Latino workers and low-wage workers, you need to start out the conversation with, first of all, how do we bolster and shore up Social Security, because that really is a bedrock of retirement security for this population. Mm-hmm. And at the same time, both low and middle-income workers need other retirement assets, right? Because right now we're looking at this big downward mobility in retirement that's coming over the next 20 years. So I do think that we need, I mean, we need a set of national standards, right? That, you know, both kind of a robust sort of social insurance system that isn't purely tied to, right, the employment relationship. And we also need a set of sort of national standards around, like, what is the kind of retirement security that everybody needs to have, not just if they happen to be lucky enough to stumble into a job or a situation that offers the right kind of plan. So I do think it would be really great to have some sort of federal policy goal, right? That this is, whether it's the Australian.
You're talking about an M word? What are you talking about here?
Right. That essentially that everybody needs to be in some kind of retirement savings plan, right? And it could be private, it could be employer sponsored, it could be the state, but basically everybody needs to be in one in addition to Social Security. I do think that that's something.
So an automatic enrollment with potentially an onus on requiring something like Treasurer Frerichs might know a bit about in Illinois. And when I said M, it was an M word. Mandate was what I was talking about there. Go ahead. What's your aspiration, Treasurer?
Boy, it's similar to what Nari just said. What you added, Ida. I'll be very selfish here and say I'd like to see Illinois Secure Choice Plus adopted at the federal level. I mean, it doesn't have to be Illinois Secure Choice, but something similar to what we've done. That automatic enrollment, that it's opt-out for employees. I'd like to see, when we talk about Plus, these programs have higher limits for contributions to allow employers to contribute. That doesn't solve the problem for your gig workers or so, it doesn't allow to, but trying to take some of the benefits from qualified plans and add them to what we're doing here in Illinois, and then really make it national. That's, there are two ways to do that. I'm a member of the National Association of State Treasurers, and we talk with our fellow state treasurers trying to get more states to sign up, but then to lobby DC when we go out there. But that can be a long-term solution. It can be tough to fight every day for something like that, not knowing if it will happen or it's going to happen a long time down the road. But I'd like talk to my staff who's on this phone here and say, let's just set up the best program possible here in Illinois. Do the best we can, provide an example for other states, for the federal government. And the hope is they'll look and say, they're doing things right there. Let's follow their example.
Thank you. And Carl, what's your own sense? What are you going to be busy with as you continue to build out your agenda?
Well, I need to talk to state treasurers more is one thing I've learned, but I would, I'm very much interested. I'm very much interested in a workforce that's going to drift back and forth between being an employee and being an independent worker. And I'm interested in us, if we're going to build state plans, which I think is great, we're much better shot at that than building a federal plan, but to build it so there's gateways in and out of their work style. So that we end the discrimination. As we talk about all the cool things we can do for employees, let's end that discrimination and say, how can we do it for all the people who are earning income, regardless of whether they're an employee or an independent worker? And how do we create a gateway between, which I've not thought about until listening to this here. What's the gateway? Is there a way so that as we see more and more movement between shorter and shorter employment durations, more and more willingness to pick up and shift to an independent work, is there a gateway so that we can unify an approach to, an enhanced retirement savings plan? I don't have a great answer, but I figure that Nari and Michael will get us to one here shortly.
We will. We'll pick up offline and get that going with all of you. We're at time. I want to thank our listeners, our stakeholders for joining us today and asking questions and tuning in. I want to thank Treasurer Frerichs, Nari, Rhee, Carl, Camden for joining me in this conversation. I want to remind you all that we'll skip a week and we'll be back the first week of July. Can you believe it's already July? For a Future of Work conversation that we'll be hosting with our colleagues at the Future of Work Initiative at the Aspen Institute. And I'm sure I'm supposed to tell you something else from the team, but I've forgotten what it is. So with that, I just really want to thank everybody and hope you have a great Wednesday. Thanks so much, everyone.
Thank you.
Bye-bye.